Hello, everyone, and welcome to a special Alto Trading live strategy session with Jeff Tompkins and special guest Brent Kochuba. We are really excited to have you guys with us here tonight. We got a lot of great information to go on. If this is your first time on, you'll notice that your microphones are muted. That's how we can hear Jeff and Brent talk, but there's a Q&A box located at the bottom of your screen. Please post questions in there. We'll answer those throughout the session and also before we sign off at the end. If you have to hop off for any reason, don't worry, this is recorded. It'll be available in the members area later tonight. We're also going to send out some recordings in the morning, and Zoom will send you one tomorrow afternoon. All right. Before I bring on Jeff, let me just read the disclaimer. Altos Trading LLC and Trade Friendly and software is intended to be used as an information service for subscribers and includes opinions as of buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading, Trade Friendly, and software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstance of any particular person. Also, Trading LLC, including its owners, and accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Friendly and software, or any other persons who buy, sell, or hold securities do so with caution and consult with a broker or an investment advisor before doing so. All right. Now the attorneys are happy. Let me bring on the man, Mr. Jeff Tompkins. Jeff, you there?
I'm here. Great to be here.
Awesome session. I'm excited.
Yeah, likewise. Yeah, and I don't know if you mentioned we're live streaming to YouTube as well.
First time.
Yeah, the first time we've done that. So you guys can watch us on YouTube. But great to be here. Hey, Vincent. Hey, Jeff. Hey, Sheree. Good to have everybody here. So we still have people coming in the room, but excited to kick this off. So we, as Richard mentioned, have a very special guest with us on tonight, Brent Kochuba from SpotGamma. So our format tonight will be a little different than typical, right? We generally start out with a market overview. We're going to do a little bit of that, but it'll be both Brent and I. So I'll be bringing Brent on shortly, but just want to give you a little background on Brent if you're not familiar with him. So he's the founder of SpotGamma, and he's been in the markets for a long time. Actually, worked with a lot of large institutions as a market maker. Has worked with hedge funds, but been in the market for decades, and launched SpotGamma, which he's going to be talking to you about on our session tonight. Super impressive platform. I'll just give my own little testimonial. I use it myself. I've been using it, and most of you know I trade on both the retail and the institutional side, and have really had a lot of frustration over the years in terms of the gap between retail and institutional tools that I'm trying to narrow. And that's part of the reason we brought Brent on tonight. Their goals are aligned at SpotGamma, so they're trying to get institutional level tools into the hands of retail traders. And so we're going to dive into this on the session tonight, and he's going to show you some really, really powerful stuff. But as I mentioned, I've been using this tool with a lot of success. So obviously, anytime we uncover something that works for us, we want to share it with all of our members. But in any case, Brent's, recently served as a portfolio manager with Seven North Capital. So he has a lot of experience on the institutional side as well. But I'll let him give more background on himself as we bring him in. So Brent, do you want to go ahead and hop on in and join us, and we can kick it off?
Yeah, hey Jeff, thank you for the kind introduction. Appreciate it. And thanks for the opportunity to speak with everybody today.
Yeah, great to have you. And I'm sure questions will come up as Brent and I talk. So if you guys do have questions, as Richard mentioned, you can post those in the Q&A box on Zoom. And you can if you're watching on YouTube, you can post those in YouTube, and Richard will relay those questions to us. But there's a lot of really good stuff to go over. So we'll pause for questions if it's time sensitive, but otherwise, we'll try to save time at the end for questions as well. So Brent, I thought maybe we could kind of kick it off by maybe talking a little bit about what's going on in the markets. I'll pull up a chart of the S&Ps, and we can kind of talk about what's going on. Just interested to get your perspective. Obviously, it's kind of an unusual market environment at the moment. We've had almost a technical correction, but an equally impressive rally back up. So what are your thoughts?
I think the rally may be more impressive than the decline, to be honest with you. And I think we're at 9 or 10 days in a row of the NASDAQ rallying. And I think what we are seeing here is a few things. and a lot of them relate to VIX expiration, which occurs tomorrow morning at 9:30 a.m. Eastern time. And part of the reason that I think people like yourself who are market practitioners for a long time and are searching for some extra data and tools is because so much of the flows now are very, very short dated in nature. And I think that the intent of those traders is short dated in nature. And so what I think happens oftentimes now, people are saying, how could they be buying this? Don't they know about the Iran war? Don't they know about this? And the Iran war is not going to flame up tomorrow. So if I'm trading zero DT, I kind of don't care about the Iran war. Maybe I don't want to get long like 3 months options because I don't know. But today, market opens at 9. Nothing's going to happen by the time 4 o'clock closes. And so my world, aka the zero DT space, is totally clear. And so I think there's a lot of that in flows now, and I think that's quite dominant. And Jeff, as you know, you joined our community yesterday. Thank you for that. I'm a talker, so just interrupt me at any moment.
Nothing wrong with that. That's why we're here.
So what's interesting about the VIX expiration? I like this audience because number one, you gave us some really interesting ideas yesterday with the strangle trades, and I put on some strangles today.
Oh.
And the reason I did that is because today's VIX expiration, well, technically it's 9:30 tomorrow morning, but today is the last day the VIX options that expire in April can trade. And so, according to my data, today is going to be or tomorrow morning will be the second largest VIX expiration in terms of number of contracts since 2020. And I call 2020 the start of the modern options market. I think you can find a few more times in there that it's a little bit longer or larger if you go back in time. So it's a massive VIX expiration. And the reason that matters is because we have, if you go through and you look at your open interest there, hundreds of thousands of puts at all those strikes. So if you look at 20, 21, 20, 19, 18, you go down there and you can see them all added up there on the right. And so what does that mean? And why do we get such a big rally? And note how fast the VIX has collapsed here over the last couple of days. When we kind of have a deal, I'm not sure if we do. I'm not a geopolitical analyst. I'm not going to offer any insights on that. This seems a little bit tenuous, right? Oil's come in, so I guess that's our barometer for truth in a way, maybe. But the VIX has collapsed quite quickly, and this is a massive expiration tomorrow. So what do I think is happening? People are shorting the snot out of volatility right now. And when they do that, it helps the market to rally. And there's a bunch of dealer mechanics I can get into on that. But I think a lot of people think of the VIX as a fear gauge, and they don't think of it as a flows system as well, right? Like if we short vol futures and we sell S&P puts and we buy VIX puts, that is all flow that essentially shorts volatility, and that makes options market makers essentially have to buy stock. And I could always explain a little bit, but there's a lot of options that are going to expire tomorrow. There's a lot of cheap options that, kind of went in the money over the last couple of days on the put side. You can see where all the big calls are on the left as well, Jeff. And now those are all essentially out of the money now, right? So it's like if you bought a VIX call and owned it for April, it's been just total destruction based on, you just add it up, right? At basically 18 and a half is, like under there is basically no positions, right? And then over it is just a lot. And so those are all going out worthless. And so let's just say, forget the flow side of things. If you're a market maker and you're, thinking about Max Payne scenario and you have a lot of exposure there, what would you want? You probably want all those calls to expire worthless, right? And so down this thing goes. And some people may be saying, well, Brent, this sounds cool, but I don't know that I believe it. If you bring up, and I put this on Twitter so you could see it, but if you just look at March VIX, right? If you look at a 1 month chart of the VIX, and you will see what the low of the VIX was there, where expiration exactly was. And you're highlighting it right there, 316, 317. So you see that candle broke that teal line. It's 2 or 3 bars to your left of that arrow right there. That's where VIX expiration occurred. And so is that like an all-time systematic low? No, but that's an Iran war low. Like don't forget the war started on March 1st. So you got this relative vol squeeze, rate on VIX expiration, that thing clears and then bam, vol spikes. And so coming full circle to why I like the strangle that you pitched, because the last 2 days we've moved 100 basis points in the S&P. So we've moved over 1%. So volatility has been pretty high. The straddle today, the zero DT straddle, as you I'm sure well know, was quite cheap. And then today I saw about 2 o'clock in the afternoon, the straddle for tomorrow was about 58 basis points. So, I think it was in the $40. So 0.55% is the straddle that you like to kind of pitch to us. Excuse me, that was a zero DT straddle. I brought the strangle. And the reason I bought that is because I think VIX expiration has the opportunity to sort of free up market movement here, right? Make volatility possibly expand some or keep it moving. And if you say, well, Brent, we've been moving at 1% moves for the last several days, the straddle's pricing in no movement, right? So it's that implied vol that I think could sort of lift here. And so, that's why I elected to do that trade because of these options expiration dynamics that are coming into play here. And there's been many times over the last couple of months that you can just mark on a chart when VIX expiration is, and you can see short-term turning points. And I would just, the last thing I would add, I typically am looking 3, 4, 5, at most 30 days out in time. So I have a very short-term time horizon on markets. I have no idea what happens after 30 days, but I think I have a pretty good idea what happens in the next few days based on options flows.
Yeah, yeah, yeah. I mean, it's impressive if you just look at today's zero DTE uh, contracts on the SPY. I mean, SPY closed up 1.22%. So I mean, it was a good move, but it wasn't anything. We've seen moves, but much bigger than that. If you look at the on the call side, if you look at the open and high of some of these in the money contracts, I mean, you look at this like 590 strike, opened up at 46 cents and hit a high of 453 intraday. But it's pretty incredible the magnitude of the percentage increase in these contracts in a single day. It still blows my mind, but just
Yeah.
looking at today, it's pretty impressive.
And what's funny about it is they'll be perpetually underpriced oftentimes. That we get into like these cycles where, like they're underpriced every day, and you're like, I just don't quite understand that. And I know the guys who are making and gals that are making those markets are smart enough, they're not making a mistake, right? So there's some other type of flow that's offsetting whatever it is they're doing, and that's all, well and good. Doesn't mean it doesn't make an opportunity for us because, as small traders, we can exploit those dynamics. If we were, if we had $100 million of calls to buy, we may change the zero DT skew a little bit, right? But if we're in here buying, 10, 20 lots or whatever it may be, then I think we can kind of get in there without making much noise.
Yeah, yeah. But the volume's impressive. I mean, if you just look at the volume in these short duration contracts, it's just, 500,000 contracts at a single strike is pretty crazy. But you brought up a good point that a lot of people don't realize is that it's really the options market that's largely driving the underlying share price, with market maker, delta neutral hedging and whatnot. And a lot of people don't realize that. So I think that's important that you mentioned it.
Yeah, and I won't sit here and say every move that takes place every day is an options related move. There's options flow every day. That's for sure. Sometimes it's the most dominant theme. Other times, something else could be happening in the market, and it's fairly easy to identify, I think, when those things are happening, right? And I think in trading, that is so much of what the key is understanding, when the thing you're watching matters more than whatever else, is happening in the market. And, that is an opportunity to exploit things, right? So when I feel like I have a lot of edge is people don't understand the options dynamic that may be in play right now, like VIX expiration tomorrow. They don't understand the options prices or whatever it may be. A lot of times too, it's like, I don't know that the market may rally or sell off, right? Because there's an Iran war, for example, and I don't know what Trump may tweet or however that may work, right? But I have an idea of the magnitude of the potential move if there's good news or bad news, for example. And so in the option space, that's always awesome because so much of what we're trading is we're just looking for the move, particularly as you mentioned with strangles, right? And so, that's an easier thing to, these if then statements. If we rally, what's possible? If we sell off, what's possible, right? And in the options positions, I think can help you sort of set up those guidelines or those parameters in some pretty interesting ways.
Yeah. And what caught my eye too was the heavy open interest. It's some of these high strikes on the call side on the VIX that,
Yeah.
that are coming off the table tomorrow. Any insight on that? I mean, like even if you go up to like the 80 strike, you got over 300,000 contracts of open interest.
The argument was coming into the Iran conflict that the market was pretty well hedged. And, you know, with the benefit of hindsight, if you look back and say, well, and again, I'm not a geopolitical analyst, but I knew that they were sending every ship basically in our armada over there or whatever it is. And it was like, you could kind of see this was happening in like slow motion, right? And so, under that idea, did people hedge what was already a telegraph thing? Maybe, right? Sure. But regardless of intent or why, those are some pretty big hedges out there. And the VIX context complex continues to grow. And why do you put those contracts on? Tail risk, right? If the market suddenly plunges out of nowhere, there are buy side shops that want to own that stuff in case all heck breaks loose, and then they could make and then it's a pretty good hedge, right? And so a lot of those contracts, I would say, in kind of the belly, the 30 to 40 to 50 strike contracts, I think are like hedge funds buying protection, right? And then when you look at the stuff that's like up above there, the 80 to 100, the kind of stuff where you go like, we're never going to get that spike. I think a lot of that stuff is actually market makers themselves who need to own these teeny options that if the end of the world or close to the end of the world happens, those things pay off, right? And having had some experience in this, you all know here, if you use Thinkorswim or something else, you get a margin call, right? Because they do this risk profile on you and they shock your portfolio. And if your portfolio is down 20%, it shows you lose 50 grand or whatever, you'll get a margin call, right? Well, it works the same way for a hedge fund or a market maker, right? They shock portfolios and say, look, if you just sold, Jeff, you're the market maker and you sold all these VIX calls from 30 to 40 and the VIX goes to 80, you're going to put your firm out of business and you're going to put me, the clearing agent, out of business, right? So no way. So they buy these cheap nickel, dime, or less super far out of the money puts or super out of far of the money VIX calls. And then if you get a collapse scenario, then those things start to pay off, right? Those actually protect you. And what's nice about that, I guess, is that I remember the 2008 crisis, a lot of the market makers had a great year. And if you look at other crises where vol just goes insane, right? These options that are so far out of the money catch a bid because people are scrambling, vol surfaces go crazy. And so that brings profit to the market makers portfolio. And then I think they can start to offer better liquidity to the market then, right? Because they're not stressed anymore because they're making all this money on these, really teeny options. And so, I think a lot of that stuff that you go, why would anybody ever own that stuff? It's for this reason, right? It's basically like these little cheap insurance contracts that for the most part, just keep the risk manager off your back.
Yeah, yeah. Yeah, and interestingly, so I launched my hedge fund back in January 2020, and that was a time when, obviously what happened in February and March with the COVID crash, where that exactly that scenario that you explained played out. I mean, there were hedge funds that went under because of, of that margin calls. And yeah, so it makes me wonder, I wasn't, I guess, paying as much attention to that on the fund side since I was just, the fund was just starting out. But I would be interested to know how much that's changed since I'm sure anytime something like that happens, the '08 crisis, the COVID crash, and funds blow up, and there's pain on the institutional side that behaviors change, right? So
Yeah.
I'd be curious to see kind of how that impacted some of what you're talking about here with some of these, low probability, far out of the money hedges. But yeah, pretty crazy.
Yeah. And I think a lot of times too, in the depth of like a crisis like that, where those VIX 100 calls catch a bid, a lot of times the liquidity is just not that great. So those can be difficult, I think, to even trade out of. So I don't even know that a lot of times those things necessarily are like monetized and that they're like, they sell them. I think they're intended to go basically, to zero, even in the midst of a crisis. But if you have that VIX 100 call that's making a whole bunch of money or generating a lot of positive P&L for portfolio, that allows you to do some other things, right? Maybe you'll sell some S&P puts or whatever, right? You can dance a little bit because that gives you some of that insurance. So,
Yeah.
and so I think a lot of times that's what happens. And particularly when people are like, "Why would somebody do that? Doesn't make any sense." They're not doing it because they think it's going to make money. They kind of have to own some of that stuff.
Yeah, yeah. Well, I'm curious about one more thing, and then I'm gonna hand it over to you so you can talk a bit about SpotGamma and share your screen. But um, I'm curious to get your insight into the oil markets, which we all know have, caught a huge bid as a result of the obvious catalysts that we're dealing with right now. So to me, there seems to be right at this very point in time a little bit of a disconnect between where oil is currently trading, whether we look at light sweet crude or Brent or whatever, but that in the fact that the markets are rallying so hard with oil still elevated. So I'm kind of curious what your insight is on that.
Yeah, I will preface this by saying I'm not again a geopolitical expert, but I've sort of had to study what's going on here, much like you, Jeff. I imagine just because we're all essentially oil derivative traders over the last month, right? Like if you owned equities and oil was going up, that didn't feel good. And the same thing with vol, right? The correlation was very high, and the link between the VIX and oil was super strong from like March up until about end of March that month, right? Where oil went up, VIX went up, and that has broken in a little way now. From what I can glean, there's two things going on. If you look at the backwardation in the oil market, the near term contracts are bid up a lot, right? And then if you look at a time, those oil prices have not moved as much, right? December contracts, things like that, didn't move at anywhere near the same pace. And so, from the people I've talked to, there's two reasons for that. Number one is, and I'm just going to say taco. Some people don't like taco, but they understand what I'm getting at when I say taco. The idea that we'll get a deal, this isn't going to stick. So that's number one. And I think that's legitimate, right? The Trump negotiation strategy is this, and we'll squeeze oil on the front end, and then it'll sort of settle down. And that spread, that backwardation got really big, right? Oil front month was 115, and you'd only have like 90, right? Out in August or September or December. So that basically said that people weren't pricing in the idea that this would be a long, protracted event, right? There's the short-term risk and then the more protracted event. And so I say, okay, I guess I could sort of get on board with that. The second one is that when you start to price in oil going so crazy, we saw this in 2008, oil went to 200, or 2007 or 2008, I forget exactly when, I'm getting old. And the demand destruction from that was incredible, right? And so if you look at a chart of 2008, oil went bananas and then it will like fell off a cliff. And it was kind of funny. We do this video called the OPEX effects, like a monthly options expiration thing. And, we were talking about how that was like the prelude to the great financial crisis, right? Because higher oil's inflation, and then credit markets start to have problems because the rates go higher. And so you start to put this mix together and you're like, that kind of looks, I don't know, we're like subprime kind of levels of crisis here, but you've seen some credit issues, right? And so, anyways, the point is that I think what happened is that you could say one of two things. People didn't think it was going to persist, or number two, the demand destruction from meaningful high oil, is pretty real. And then the other thing is that it seems like there's a lot of other things going on out there in the Middle East, and everyone focuses on the Strait, but there's different pipelines and there's different ways to ship oil. And now there's oil coming to, people coming to the Gulf Coast to fill up their tankers. And so I think in the short term, there was a lot of unknowns in terms of how the oil market would operate. And then it's like, well, in 2 or 3 months, there's a bunch of other things we can figure out. There's a Saudi Arabia pipeline or this or that other thing. And so like, okay. And no one, that's under the guise of no one assumed there would be a much more significant Iran war issue. I would just also state lastly that, the Ukraine-Russia war, for example, still a hot war as far as I know, right? Yeah, there are rumors about maybe they'll calm down or whatever, but like the market has a tendency to just kind of forget about these things and move on. So really all that you're pricing in terms of the equity market here is a significant escalation where maybe like troops in the ground in the US. And it's like, is that going to happen? Is that not? I don't know. But all I would just say is we have to get it. It has to be a materially worse situation for the market to care about it at this moment. Just kind of like mired in a conflict, I don't think the market really cares. If something happens to the AI market, that's a different story, right? But protect our tokens at all costs. But that's kind of like my somewhat ignorant take on this and the things I've been able to put together.
No, I think you're spot on. I think you hit the nail on the head there, and I think all of our members appreciate that insight. But I think, yeah, the key takeaway is the market forgets very quickly, and even when these types of catalysts aren't resolved, the market can recover. So you really have to have, I think that's a good segue into the fact that you have to have really good tools and information to be able to get ahead of all that, because that's where I think a lot of people get trapped,
Hmm.
especially on the retail side. They, for the most part, are reacting to things, reacting to news headlines, even the price. But if you're reacting to price, you're often too late. So you have to have something that can give you some sort of foresight. So in other words, you need to know ahead of time where markets are likely to reverse or stall out. And there's a number of ways to do that. But I think that's a good segue into allowing you to share what you've developed over at SpotGamma. So I'm gonna let you share your screen if that's okay.
Yeah, that'd be great. And I'm gonna send the request over to you there. I'm gonna talk a lot. I'm gonna frame up the zero DT market for everybody here, and so I think even if clearly if you're with Altos, you know about 0 and 1 DT options, but I think understanding the size of what's happening is a kind of a critical thing. And what I enjoyed so much about my conversation with you yesterday, Jeff, is that I come across a lot of people who, and hopefully you can see my screen okay here. I come across a lot of traders who they just want to sell options. That's all they'll ever want to do, no matter what. And sometimes I think that's a good idea. Other times I'm like, I don't think that's a good idea. But there's this like meme out there that like 90% of options expire worthless, and so I should sell them, and that works great. But it's a negatively skewed payoff, right? You're right 9 times out of 10, and then you get your face ripped off. So I just want to I lead with that because I don't have an axe to grind. I am looking for the way to like exploit whatever the market may be giving me, and I think the older I get and the more I trade, the more that I understand that sometimes what I'm trying to do is just sell the expensive thing and buy the cheap thing, and then hope it kind of like plays out in my favor. And so I'll be quick with the slides here, but I just want to show the last few days. And so the tool we just launched recently, we call it Trace, and I think it's the best zero DT tool you can get. And what we do here is we take this data from the CBOE exchange. We get this data from all the exchanges, but particularly for S&P 500, and they tell us who is doing what, and then we can model that. So what do I mean by that? Like, did a hedge fund buy this, or did like a market maker buy this option, or like how does that work? And then we model this in certain different ways. And what you're seeing on your map here is it's a measure of what we call gamma for market makers. And I don't want to get into all the dealer dynamics because I don't want to like cloud the underlying point. And when you were giving your talk yesterday, I just saw these like light bulbs, like, yes, this can like help you in some pretty unique ways. And I just took the last 4 days. So April 9th, this is a map of 9:30 in the morning, roughly. This is the S&P 500. And so, what are these bars here, right? This is market makers are long what we call gamma. So, you can also look at this at net OI, right? So what is this market makers? If you see orange, these are call options. So you go, well, Brent, that's a little weird. And I'm only looking at 0DT. The market makers really only had call option positions on the ninth. Like, oh, that's kind of interesting, number one. But number two, where are the big positions? You can see there's some here at 67.40, and then there's a bunch up here at like 68.20, and then another concentration here. And at the time, these are like 5,000 to 7,000 contracts at 9:30 in the morning. So this is where the S&P is. So we're right about 9:30, right? And so if you own, I don't know what the Strangle or Straddle was priced on that day. I think I maybe made a note of it in our notes, but you may know. But this is a pretty good move, right? It's about 50 handles to go from here to here. That's a zero. And then to the downside, it's about 25, right? To get to these levels. And the rub here is that you will find that these giant positions in SPX 0DT will act as support and resistance, or oftentimes I'll just call them targets now because I think it's less confusing. Like, if you stick out like a sore thumb, 10,000 S&P contracts, market's probably going to move to that level, right? Now, in this case, what you see happens is around 11:30 or 10 o'clock, right? There was a little bit of a rumor of some peace with one country and another country. Whatever it was, it was a little bit of positive news. And then you just see the market rip, right? And it rips right into these areas where these really big contracts are, particularly this one right here. In fact, this ended up as a 27,000 lot options contract position. So what happened there? Market went straight up there. I didn't know, and I write a note every morning at 7 in the morning. This was a 5,000 lot. I had no idea, right? Because what happens now is these contracts come in at 9:30, 10 o'clock, 10, they come in at any moment, right? I have no idea what people may or may not do, but within a minute of them trading, you will see it on this map. And if you want to get into this conspiracy corner, right? We traded till about right here. And then it was right about here where all of a sudden somebody bought 27,000 contracts. Market makers are short 20,000. For a market maker to be short the calls, someone had to buy them, right? They bought them all right in here. And then that news came out and then the market ripped. Nice trade, right? $2 million of premium turned into quite a bit more. Kudos to them. But then what you see here is then the market is done. So I like to call these targets because if I own the strangle or the straddle, and I know you said sometimes your profit target, you like to do 2x, right? But if you had a reason to say, let me monetize it a little earlier, or hold it a little bit longer because I know this big gamma position's there, or let me sell that call above and lock in some of those profits because we may not run through there, it gives you some extra information because unless you were watching those options positions, you quite frankly wouldn't know that that was there, right? Like if you were doing like a Fibonacci or retracement or something, I don't think you would have seen 6830. So the 10th, it turns out, was a very quiet day. There was no big position, so I don't have anything to show on the 10th. But Monday, same thing, right? Huge positions up here, 6860. There's like a call spread. You can see it, right? Market makers own the 6860. They're short the 6865. Right there. And it's about 10,000. This is about 10 o'clock in the morning. And then the market just sort of trades up to that level, right? That it just moves up to that level and we close right at that level again. So that was Monday, right on that 68.65 call spread. And then you fast forward to today, we put this presentation together about midday. What happened today? 69.50. There was about 10,000 contracts. It went to about 12,000 on the day, and you see the market just move up there. And I think we just kind of did one of those and basically closed, right at that level again. So what you see is day after day after day after day, these positions come into play like this. And it happens to the downside as well, where you'll see someone put a big put position in, particularly zero DTE. And it happens with such consistency, we nicknamed it seek and destroy because it's like, the market has to touch one of these strikes with the big positions. And for those of you who've ever followed like volume profile or anything like that, it's like market goes to where the liquidity is, right? And so what's also interesting to me about that idea is that if we sell off, let's say 1% because there's a 20,000 lot zero to D put, not that nervous about the next day because I know someone just had to move the market to mess with that 20,000 lot zero to D put, and then they'll go on about their business the next day. And so I thought this was interesting. A lot of times people are like, check out what happened, last June 26th when this interesting thing happened. But we just took the last 3 days, and I hope that, add some weight to kind of what's happening, I guess I would say. And so I think a lot of times what happens in the market now, and it didn't used to be this way. I think what used to happen in markets is it used to be a headline would hit, and then, people would say, well, this is important or this is not important. And then the market would kind of react to the headline. And I think what happens now is you see a headline and then the market moves. Oftentimes now we see these just kind of ridiculous market moves on not a whole lot. And then all of a sudden, people are like, well, the market moved 6% on that headline. So that headline must be really important. And what's happening is these short-term options, which is an option is just leverage, right? And so when you have zero DT options, that's a lot of gamma, i.e. leverage, and that's whipping the market around. And so people go, well, NVIDIA dropped 14% today on the DeepSeek news because DeepSeek must be about to end its business, for that to happen. And it turns out, well, there was just a whole bunch of short put holders that got blown out on that day, and that's why the stock dropped 14%, not because DeepSeek is about to end its, end its life. Same thing like, Trump and Elon were tweeting, I don't know, it's about a year ago, I guess now, time flies. And the stock's down 14%. Be like, oh, Tesla's, it's over for Tesla, right? But Tesla and NVIDIA have the biggest options complexes of any single stock, for example. So what we did here again with this visualization, red is good. Red is bad, means high volatility zones. Blue are low volatility zones. And then you just end up with these strikes over here, which update throughout the day as big positive and negative gamma strikes. We just call them targets. Upside or downside targets is the way that you can think about them. And there's a bunch of data and stats in there. So if you hover over a strike, it goes, yes, this is big, or no, this is small. Because obviously there's a lot of information on that chart and you want to try to put that together. But while that is somewhat, I would like to call it sophisticated, some may call it a little complicated. It can be as easy as this, right? Where's the strike? And I put a bunch of this on Twitter today so you can verify that I was flagging some of this stuff. I understand a lot of these things come with hindsight. So how big is the actual zero DTE market right now? First, let's put it in the context of overall options market. It's up 200% in terms of volume now since 2020. That's why I call it kind of the modern options market. And that's outpacing stock volume heavily, handily, as you can see here. Every month or so, we get some sort of record or never before seen thing, like, tomorrow being the second largest fixed expiration in the last 6 years, for example, right? And what's happened is they now announced Monday, Wednesday, Friday contracts for Mag 7s, right? And guess what? They're going to keep rolling new products out. And that has two effects. Number one, it's such a cash cow for the exchanges to have these short-term options and the brokers, right? Because people love to trade them. So that pulls the volume forward. More volume now trades in the 0 to 5 DTE space than, Jeff, when you and I started out trading, it was like people would trade the monthly. It would be like 30 days out. And you'd be like, 1 month option was the short duration option. Now it's like medium. So it's funny. And a brief, so how does this actually work? We're all traders here, right? We are on Thinkorswim or Tasty Trade or whatever we may do. And we all want to buy calls for 1 DTE because Jeff puts out this strangle idea and we're like, awesome. So we all go buy calls for tomorrow. Market maker has to sell them and then they need to hedge that position. So if the market makers are short all of these calls, then they would have to buy stock as their initial hedge, right? And delta is the way that we would measure that initial hedge. And you're sometimes talking about millions of shares, on the hop, right? So it's like if we all pound the screens right now because Jeff just put his new, I don't know that's how you operate, but 10 o'clock, you put your newsletter out and like, great, 700 people, like, great, we got to go buy these calls. And it works in the single stock space too. But the hedge works for right here, right now. What do I mean by that? If the stock moves at all, you got to adjust your hedge. That's the gamma hedge, right? If time passes, let's say the stock does nothing, it just sits there, but Friday's options expiration, right? So every day we move forward, that option decays and that invokes more flows that have to be traded. So people call that charm oftentimes. And then the other dynamic that is the big one is volatility going up and down. So we're talking initially about VIX goes down or VIX goes up. That actually generates market flows, right? Well, if the implied vol of your option goes up or down, or the market maker option that goes up and down, they have to hedge that as well. So you have price, volatility, and time. Those things are constantly changing, and those things are dynamics that we can predict or model to understand how the related hedging flows will move the market. Hopefully everyone's still with me here. What about zero DTE? We had a record 70% of SPX contracts recently show up in the zero DTE space. We're consistently over 55, 60 to 65%. In a safe, stable, calm market, 65% is normal. What is interesting is when vol starts to spike and you get a known unknown, I know you use that term too the other day there, Jeff, Iran war, right? I don't know when this is going to, how it's going to end. Bank collapses. Are there going to be other banks? I don't know. Why does that matter? Because I can't hedge out a possible armed nuclear conflict with the zero DT option. If a bank may collapse tonight when I go to bed, I can't hedge that with the zero DT option. I got to buy that 1 month, 2 month, 3 month option, right? So the tenor goes out in time when people start to get worried about systematic risk or systemic risk, either one. And so if you look at NDX will be 75% of zero DT. Same thing for spiders and Qs. You're talking in that 60 to 80% of daily volume is in zero DTE. For those of you who understand kind of GEX and gamma modeling too, you'll see a lot of people put out information like gamma is highest or lowest and da-da-da-da. When 60% of the options come in zero DTE, that's like the bulk of gamma that we're measuring, right? Now comes in after 9:30 and it's gone by 4 o'clock. So it shifts the balance of power so quickly now, which if I'm being honest about it, my preference would be that it's not also sporadic, right? Sometimes I just wish it was like, we don't have to focus so much on the zero DT space, to be honest with you, but what are you going to do? That's where the volume is, and that's where the flows are, and that's where the impact is. And so every once in a while, I'll be like, I'd love to write a weekly newsletter, but that's that's not how it goes. And so, just a quick punch on our platform here. We have a bunch of different systems. Trace is mainly what I'm talking about here with you all today because I think it ties in so well with a lot of things that Jeff likes to watch. But we have a lot of this data on individual stocks, and then we have a lot of volatility tools, which I think can be very helpful as well when you're trying to model out if options are cheap or rich. Are the calls cheap or rich? What tenor, right, out in time? We have some options calculators and some different things like that. And just on that point, I don't do a lot in SpotGam of telling you sort of like how to trade and what you should do, right? And so if you think about the market rallying to a certain level, a lot of people use our platform to help them trade futures. A lot of people love to sell zero DT options only. A lot of people trade, swing trading or this or that, right? And so what I'm here to do is sort of like put the options overlay, the data overlay on whatever you're doing, right? And every once in a while, I have a strong feeling like options are too cheap to sell. Maybe don't do that, right? As a piece of advice, but by and large, I'm not here to give you a strategy like the folks at Altos do. And so I think I talked to a bunch of different modalities, right? I was talking to some futures guys 2 days ago, and they love to watch VWAP, right? And they looked at VWAP and these options levels and are like, wow, this is kind of interesting that a lot of the volume shows up around the big option strikes. And it was like, well, if you believe in options hedging, then that's stock volume. And so I guess those things should overlap, right? And so we have a wide breadth of customers and clients, hedge funds, banks, and then a lot of, I call us pro tail traders, people like, Jeff, you and me, who are, sophisticated in what we do and we take it seriously, as opposed to, like the kind of GameStop people who come in and blow up and leave. So I like to, speak to that sort of audience. And I write daily notes every day around 7:30 in the morning. I put a daily note that just talks about the dynamics that I see in the market. And so, that's all part of the platform here. We try to give you that 360 view of just what's happening in the options market. And so I think a lot of people like to outsource that view of things to me, even if they're not necessarily interested in trading options, they still have to know what's going on in the options market, and then they'll be flagged to these rather unusual flows on a day-to-day basis. And so I want to talk a couple of things about VIX options expiration and some things like that I saw kind of quickly. And so I would just get to this offer that we have for everybody here at Altos. We're getting 75% off your first month of Alpha, which gives you that Trace membership. And so if you go to spotgamma.com/Altos, you get 75% off your first month. I do twice weekly Q&As and some different things like that as well. So we try to get kind of everyone up to speed. And so we'd love to see you all over at SpotGamma. And again, 75% off your first month is as good of a deal as we give around here. And then, that's all set up for you there if you go to spotgamma.com/Altos. And so if you permit me a few more minutes, Jeff, I wanted to talk about that dynamics that I saw with the zero DT space and why I think VIX expiration is tomorrow. I'm not a super sales guy, so I don't want to like finish on a sales note if that's cool.
No, take your time. Take your time.
Okay, cool.
I'll just quickly before you go on, I'll just say that I really have enjoyed the trace feature. I do chart analysis. So I've identified, visually technical levels of horizontal support and resistance, static and dynamic support and resistance. And I've been just blown away that, what has lined up inside Trace and SpotGamma. It's just like, wow, this is amazing. And the fact that you can see a lot of this ahead of time, I mean, it's just such an incredible tool. But anyway, I just wanted to throw that in there.
Well, thank you, man. I appreciate that. And it has been this Trace tool here is like our marquee tool. And we launched the original version about 2 years ago now. And we just did a huge update on it earlier this week. Some new data was made available by the exchanges. And so I think we're the first one to plug that in. Basically, the map used to update every 10 minutes. Now it updates every minute. And we added some other kind of bells and whistles. And I'm trying to keep this, high level, because if I dive too deep into the gamma nonsense, I don't call it nonsense. It's like half my life. But if I dive too deep into the weeds, I think it sort of just clouds the point here, which is like you see huge zero DT positions come in, and and the market moves to those levels, and it happens with an incredible consistency. And a lot of it is then how do you take advantage of that? Like how do you trade it? And selling options is oftentimes obviously a great methodology to exploit that, but I think too often people sell the cheap option, and that gets them in a little bit of trouble. And so uh, I guess if we this is the trace tool live, right? And I know I already talked about today in that session, but you can go back in time, and then you can go back in dates as well, right? And see how other days performed. Um, but when the market opens, right, you see this where this is, if you see blue, that means the market should be pretty stable. Why does that matter if the market's going to be stable? Because vol should come in, right? And if vol comes in, that puts that bid into the market. So, that's what I think is so important here. And you hover over that strike, you can see it's 98th percentile, right? And then if you just play the market forward a little bit, it's growing in size, right? So, 8,000, and then at some point here, it jumps up a little bit. There it goes. So you can see 10,000. And so when you're talking about your strangle strategy and when do you trade out of that, for example, and we were talking about interesting ideas, like do you sell the call at maybe 2x, but you'd sell the put at 4x, for example, if you thought that there was more downside potential than upside potential. And so in here, when you know, or when you believe strongly that the market now, before you go like, is a 1% rally really possible here? I mean, this are 20 more handles on this market, right? Well, if you have this big position, that's this flow, this source of flow, then you suddenly go, oh yeah, like completely makes sense that we could rally up to that level. And what I think this matters is because when you guys trade 0D, you probably know this, that like right here, the minute that the S&P touches that level, right, that contract has the most like energy in it, if it's 0DT in particular. Why? Because you have 4 or 5 hours left in the day, but also in the midst of the move, like in the midst of the volatility, is when that option has its highest value, right? Its highest extrinsic value. And so I've seen this so many times where if you catch the sale right there, right, that option may be worth, I'm just saying, we'll have an option that's worth $1 or $2, let's say $2. And then you go like this, and the market just sort of planes out, right? It stops doing something. Well, within about 20 or 30 minutes, that option will go from $2 to $1 because the vol came out of the market, right? That 0DTE movement kind of got sucked out of the market. And so, we moved a little bit through this strike, and then we kind of just waffled back and forth. You can see here's that 68.60. And so, your brain goes, well, like there's a whole bunch of things I could have done. I could have sold another call that could lock in part of my, profit on this. I could have just rolled it to something else, whatever. There's a bunch of different things you could do when you have that target and that strong kind of magnet area to think about. And I think that's so valuable. And if you want to just see the gamma positions in here, gamma is the amount of hedging flow, right, on a dollar 1% basis. That strike generates about $15 billion worth of gamma on a plus or minus 1% move. And as you see there, that's 99th percentile. So we call these 99th percentile strikes. If you see 99 on our board, it's a big strike and it matters to the market. And that's kind of it, right? And that's the only thing you kind of really have to know about that. And if you think about Max Payne, most of you are probably familiar with that scenario, right? Like, well, if the market maker is short those calls, where do they want the market to close ideally, right? They want those things to expire worthless. Hedging flows and all, that's kind of like best case scenario there. And so, that's why I think oftentimes the market will just, move to these levels and then just sort of stop. And the other interesting thing to note about this too is obviously gamma is highest for at the money options. So the closer we get to the end of the day, the gamma at that position is naturally increasing because we're on that strike and you're getting closer and closer and closer. That means the amount of hedging flow tied to that strike is only increasing. And that makes that even more of a kind of a penny type area or like a magnet type area. So those are some of the dynamics behind why I think the strikes are so consistently targeted or tagged. And while we're on here, we can sort of look forward in time. So I was talking about the idea of VIX expiration being a potential turning point for implied volatility for market movement. And so if blue is what we call positive gamma or stability, if you set this map forward in time, you can see here is tomorrow's options expiration. So the 15th tomorrow morning, we're going to see those contracts expire. And then here's the 16th and the 17th expiration, right? So every day there's contracts expiring. When those contracts expire, they change the dynamics of the hedging. So, there's a ton of a positive gamma here. You can see there's a little more positive gamma here. Generally, it's pretty much blue. And then you can see some signs on OPEX on Friday that this thing may start to shift a little bit, and that we oftentimes call this a window of historically weakness, but it's really a window of change. But you can see the color scheme is getting a little bit lighter now with the 0DT positions. That's going to change a little bit. But my general takeaway from this map is this thick, I call it thick positive gamma that suppresses volatility. It kind of keeps the market stable is the way I would talk about it. Could potentially, loosen up a little bit because of the VIX expiration. And so in the morning note, I posted this stuff about the that's our afternoon note. Sorry, I want to show this chart here. So this is the second largest VIX expiration since 2020. It's top 7 as far as my data has. It's like number 7. But you can see the put call ratio here. This simple VIX call put ratio on both volume and open interest, right? And so you can see that ratios come down. So what does that mean here? It means that obviously the number of puts is shifting relative to the number of calls, right? You're seeing that change here now as we get into the expiration, right? The positions are adjusting. And if you look at the spread here, right, you see that VIX calls over time. I tend to look at the open interest here, but you can see the VIX puts were growing here, recently, right? So there's a small blip in calls. It didn't really invoke a bunch of calls. I realize it's a long-term chart, but you're going to lose again most of the volume that we've seen, or most of the open interest in the VIX contract space yesterday. And so what that means to me is that a lot of puts, like, that's going to drop fairly sharply. So will calls. But why do the VIX puts matter? Because people are betting on VIX and volatility collapsing. Like, anytime you go on Twitter, you will find these guys who are like, volatility always mean revert. So that means I'm going to, short UVXY every time vol, spikes. And over some time frame, that is right. But there's path dependency in there, right? VXX or whatever could double before it goes down. And so, anyways, I'm getting a little long-winded here and simply saying people were betting on VIX was going to collapse. And so VIX came down sharply. You could see these dynamics changing the last few days here, right? And all of that is happening with VIX expiration tomorrow morning. And so if we go and we just look at what the vols are doing here, and if I just bring up SPX, for at the money options right now, and this is a little bit longer dated option, you're seeing that today's implied vol is about a 14. So if you all know the rule of 16, right? Divide that 14.7, you divide that by 16, and that tells you the daily move. It's actually 15.5, but 1 month options are still pricing in about 1% daily moves in the S&P, which is like, okay, that's the statistical 90-day range you're seeing there in teal. So these options writ large have come down in price a pretty decent amount, right? But these are 1 month options. What kind of gets more interesting are these shorter dated options. And so, Jeff, I know you've been doing this for a long time. You could see here, right? This is the term structure in the S&P, and I'll just turn off some of these things because you just see how low, right, or the contango of this market now, where the 1 DTE is getting even cheaper now. Occasionally, you'll see these things trade for sub 10. So if we look at another way of looking at this, we call this the fixed strike matrix, and all this is strikes on the x-axis and the expirations on the y. And so there have been on occasions times where you'll see the at the money or somewhere in the 0 DT or 1 DT skew, you'll see that under 10%. So we're not quite there, which means this isn't like the cheapest vol I've ever seen. But you start thinking about 2 days on time. I think on Thursday, we got VIX expiration tomorrow. Thursday, we have Iran and Trump. I don't know if they're meeting or there's some, apparently some news. And then you obviously have OPEX as well. And so you can see for this week how cheap those options are. And then when you go out a little bit more in time, the vols tick up a little bit, as is natural. But, you're looking at 420. You're paying 12% for, a 25 delta call or whatever it is in the S&P. That's overall pretty cheap, right? That's really quite low. And then what about the downside? Like if you're talking about a 25 delta put, these puts were much more expensive 2, 3 weeks ago, right? And the reason that matters to me is because I think they got prohibitively expensive. What does that mean? If you buy a put when the VIX is at, let's just say 50, you're probably going to lose money on it. Even if the S&P goes down, you paid such a high price, you're just not going to make money on it, right? It's an expensive option. Does that mean you want to sell it? Well, if you think a nuke is going to go off, no, right? But, do you want to buy that? You're probably going to lose money. Not a great purchase, right? Why does that matter? Because when the options get expensive, everyone else is waiting on those things, the signal, right? The bat signal that they can sell them, and they come in and they crush that vol, they sell the puts Q comes down, and it's like a ramp for the equity market, right? Because that vol getting sold leads market makers to have to buy stock, and that pushes the stock market up. So I think when you look at this and you're trying to say, well, how cheap or rich is that strangle, right? That Jeff, you like to talk about, or some of the other single stock names that you're looking at as well. How cheap or rich is that? You can have these Z scores and this data and information to really say, oh, it is actually really cheap. Great time for me to deploy this strategy. Sometimes these options are expensive and maybe you don't want to do the strangle. Maybe you want to sell the iron fly or, whatever else it may be. Again, I think that overlays and is really just sort of helpful. And um, I guess I will I know we're getting to the top of the hour. And so I don't want this to feel like I'm hoping that there was a lot of education embedded in this, or at least some of the ways that I look at the market. And if you just look at the way, so I mark every options expiration. I've been doing this since 2020. So every month I'm marking the options expirations. Forgive my lines. They overlap here. Let me fix my chart a little bit. Not every options expiration is like the mother of all options expirations and holy cow, watch out, right? But where it gets most interesting to me is where you get a big move into the expiration, because that trend is being oftentimes reinforced by the dynamics we talked about today, right? Vol gets squashed, calls get bid up, positions build up around VIX expiration or large gamma positions, et cetera. You can see this in single stocks too, right? If you remember July of 2024 and Jensen Huang's signing, a woman's t-shirt and all that sort of stuff, and people are just losing their mind. And then all of a sudden calls get so expensive that you will never make money on that call. The stock had to double in a month for you to make money on those calls, right? They're too rich. And what happens? Wall Street guys come in and sell those calls, right? And then it stops the bus. So why does this matter? You can see these turning points, right? And it's not always, right, because different expirations have different sizes, but this is Thanksgiving. And so, there's the market low, right? VIX expiration and November OPEX, and we rally into Thanksgiving. What's so important about Thanksgiving? Why did that matter? Because it's Black Friday, it's a holiday, shorter market week. Vol was super expensive a week before, and then you go, I'm going to eat some turkey and watch football on a half day. I don't want to be long puts over that week for sure, right? So what happens? Market rips, and then the high of the market is Black Friday, right? And okay, we don't necessarily have a giant sell-off. We have a small consolidation. But if you were long calls and you sold them here, you probably made a lot more money if you sold them there, right? Because that upside vol is still vol. And if you're long calls, you want to sell into that, obviously you want to pick the perfect peak, but you want that upside energy, for example. And so, nobody wanted calls here, right? Puts were expensive, but if you sold the put and bought the call, you're amazing. And then you see the same thing around other holidays, right? Like Christmas Eve. Again, we're all opening presents, or, we have Hanukkah or whatever else we got going on. I don't want to own puts over that time, because I'm just going to pay the price of them. So you see the market will, shift and rally. And, there's, January, whatever. If you go back in time and you look at February expiration, look at last year. We started to sell February into March, and then at March expiration, we had the tariff tantrums. And then right after March quarterly expiration is when all heck broke loose. When did the COVID crash break, Jeff? I know you know that one. Remember, everyone was like, I see people dying in China and stuff like that. Why doesn't the market care? And it cared when? The day after February options expiration. So it's pretty interesting, that timing. So you can look at this chart for last year. You'll see the same thing. Now, March is an interesting one. Why is March an interesting one? Because you can make an argument out of a small blip, right? I mean, I'm not gonna sit here and say clearly we had a turning point there, right? But why does this matter? There's a huge trade called the JP Morgan collar trade. It expired at 64.75. And if you look that up, Google it. You don't even use SpotGamma. You can if you want, but you'll just find a ton of stuff on Twitter about it. Huge options position that expires on the quarterly expiration. That's the 31st. Market rips through that strike, right? And you have this giant upside move all of a sudden. Um, so, okay, you want to make the argument that that's fine, that there are quarter end flows that were bullish and blah, blah, blah. That's fine. But I can tell you absolutely for a fact there was a giant hedge fund put position that got closed up that day and rolled 30,000 lot. And it's a very well known position. So let's get to the point, right? Okay. Hopefully you can see those are turning points. But this is March options expiration, right? And so here's Wednesday, right? And I'm looking at the S&P 500, and you see what happens, right at VIX expiration. You see the market sort of gets weaker, right? And it starts to fall down into March options expiration. And we're short-term traders, so these types of moves are pretty significant. We go from 6,700 to 6,500. So for us in 0DT, 1DT land, that's a pretty good move, right? Swing trader or some guy investing for 10 years is not going to look at that and think anything about it. But for us, it matters. And before I move off this chart, I mean, if you were going to smack vol to death, right, and then show me VIX expiration is right here, that's pretty interesting how those stars align. And then you want to add on to it, well, 9 or 10 days of a NASDAQ rally, which I don't know where that ranks in terms of streaks, but I think, there's not too many other times that we've had 10 days of NDX rallies. And the vol the vol is pretty cheap. So why does that matter? Because that energy of vol getting smacked now should run out, in my view, because you look at the fixed strike vols or whatever they may be, the options prices, they're pretty cheap now. War's not over. And we have this VIX expiration, which I would argue helped to drive volatilities down, right? So very interesting how those things line up. And then if you just look at this from the VIX perspective, so the way that this actually works, to be very clear, 9:30 tomorrow morning is when the options for VIX expire, right? The VIX 15. You can't trade those VIX calls or puts in the morning, even though they expire tomorrow morning, right? Last day to trade those was today. What you can do, and there was a lawsuit about this many years ago to wipe out some shenanigans, but the lawsuit is interesting because it gave some background, is you could trade S&P index options to move the price of the VIX. Now, if the VIX is moving because you're just doing natural hedging or whatever it is, that's not illegal. But if you're trying to move the VIX by selling S&P, you're not supposed to do that. Shades of gray into which one matters. But the reason I tell you all that is because there are a silly number of times that you see bizarre market movements right at that 9:30 cash open. And we chronicle this stuff on Twitter and then founders of stuff, just so you know that it's not me hindsighting things. And, am I going to bet my life tomorrow that some, wonky move happens at the open? No, I did the Jeff Strangle strategy. So I just want some movement tomorrow. I don't really care what it is. That would be great. But why did I bring this up? Because, Jeff highlighted before when the VIX options expired, right? Well, this is when they expired in March. And again, this is the VIX. So the Iran war starts here. We kind of have one of these. And then for whatever reason, for 2 days, we open at 9:30 in the morning is when it settles. We open at the low of the VIX on the day of the options expiration. And then from there, vol just kind of spikes. So you go, there's no possible way that is just coincidence, because you see it happen all the time, right? That this stuff happens. And so, is it just hedging flows and not manipulation? Whatever. One man's hedging is another one man's manipulation, I guess. But you will see that kind of stuff happen all the time. So again, just pounding the table on that, because this was a very volatile period, like very ugly situation, bombs and death and all that sort of stuff. And vol clearly went up over that time. It took a break right here though, right? Which is just funny. And so tomorrow we're going to have, as you can see right here, we're at the 1 month low in the VIX with all these contracts expiring. Now, My first order effect of this is I think volatility expands. What does that mean? Big market move up or down? Like that's just the general way I'm thinking about it. You get one kind of ugly headline or whatever it may be, and that's where you maybe have a 1 or 2% correction. Again, if you're in the 0 1 TD space, that's amazing. If you are a 6 month or 10-year long-term investor, you may not notice that type of a blip, but that consolidation, right, and a little bit of mean reversion higher in vol, I think is sort of the thing that, I'm thinking about here. Now, we may get that 1 or 2% correction, and then Tesla announces the best earnings they've ever seen, and then maybe we just start to rally next week. I'm talking about what I'm seeing in these short-term movements, in these moments where, hey, I think I have a trade here that I can exploit based on cheap vol, 10 days of rally, VIX expiration tomorrow, options expiration Friday. They're statistically shown to be turning points. There's some data on that as well. So those are the types of things that I think, again, line up well with what you're doing. I will never at SpotGamma, I never go and say like buy this call and sell that one. It's just not so, like I talk about the overall pictures, and so that's why I think oftentimes we dovetail well with people like yourself, where you guys are the practitioners saying, I love this strategy and this is specifically what we want to do, and then you can map out these flows on top of that as a rough idea. And so I've spoken a lot. I've now used up more than my time. So I
It's
will
great. It's
get
absolutely
through.
great. Yeah. And I think that's probably where viewers are maybe trying to tie things together is, how do I, this is all great information. How do I apply it? Uh, well, I can first and foremost say that what Brent is covering, uh, we're incorporating into the recommendations that we sent out. So, we're looking at gamma levels, levels where price is likely to gravitate or magnetize toward and reject or stall and consolidate, or if it passes that level, those can be great trades as well, because then you start getting that gamma acceleration. So, in terms of application, that's really how I use it, and where I think it becomes useful. And what's cool is you can really apply it to any strategy, right? Whether you're selling premium, buying premium, doing straddles, strangles, selling credit spreads, buying vertical debit spreads. You can really apply this to anything. Even if you're not trading the options, it's critical information, right? Knowing where the levels are. I love this, by the way. I love this volatility dashboard. Looking at the matrix, just quickly allows you to visualize, like, am I over different time periods? What am I overpaying? Am I underpaying? Am I
Yeah.
getting a deal? I love that.
This feature is kind of cool. I don't know if you've seen it, Jeff. We call it skew premium. So we basically calculate how much skew premium different options have. So a lot of times people are like, well, I want to sell like a 25 Delta strike. I don't know specifically which one. And so, these are the options that have the fatter relative skew premium if you did want to sell them. Or if you wanted to buy the strangle, maybe you want to buy the one that has the lowest skew premium, as like a rough example. But like another thing that I think dovetails just well with you is we have this scanner, right? And this is for 1 month options, but you could put in the software stocks, for example, right? And so you go, okay, Shopify, 10th percentile call skew, right? So calls are very, very cheap relative to puts. And so, that gives a high level overview, but then what are you exactly going to do, right? And so I know this is where you excel with the strategies, but just the top of funnel idea generation before you kind of dig into the nitty gritty, I think can be helpful.
Yeah, absolutely. Well, there are some questions that have come in, if you don't mind sticking around
Sure.
a little bit to answer. And I'm not monitoring the YouTube side. So, Richard, I'll go through some here, and if there are any that have come in on the YouTube side, you can relay those as well. Let's see. And by the way, guys, if you do have questions, you can make sure to throw those in the Q&A, since the chat with a lot of people on the session, it's difficult for us to manage that chat. So if you could use the Q&A box, that'd be great. Let's see. There was a question that came in much earlier. So this is probably about 30 minutes ago. So maybe a little challenging to correlate this to what you were talking about. But there was a question: are the large call positions always interpreted as short positions?
No. So we get data that tells us whether contracts are bought or sold and who sold them. So you can see in this box right here, right? Market makers, customers is retail and hedge funds like us. Pro customers are like high frequency traders, you would call them. They get a special designation because they trade with a lot of frequency, and so they get a special class. And then there's broker dealers and firms, which is essentially like banks. So like JP Morgan and Goldman, when they trade, they'll roughly fall into like one of these two categories. So that comes from an exchange feed, and then they're telling us bought and sold, and we take that data, we do some modeling to that data, and that's what you're seeing here. And so when you look at net open interest, you can see open interest for all expirations if you want, or just zero DTE. And so this is changing every minute of the day, and we've been aggregating and monitoring this data for years now. So we have a full book of options, not just in the S&P, but also in single stocks of how people are positioned. And that's what we try to use as a core piece of information. So some of you probably just noticed like there's this giant position up here, right? 200,000 contracts. This is a box spread, I believe. So it's a financing trade. So if you look down, farther down in the strike, there's another put and call, and what they're trying to do is basically collect a certain amount of like interest, essentially. So if you look at box spreads, you can find that. This actually is a position neutral, a hedge neutral position, so it doesn't have any impact in terms of how I try to monitor the market. But if you're looking up there and you're going, who would sell puts deep in the money? What? It's because it's this box spread, which again is a financing trade.
Yeah. Hey, by the way, Vincent is on. He threw in the chat. Brent, your comment about NVIDIA options being cheap yesterday was spot on. He apparently made a 162% return in one day on those. So
nice.
Little thank you from Vincent in the chat.
Yeah, I don't typically recommend trades, and then even when I do, I'm somewhat vague. And so just the reason that I bought this, because I think would also sync with you, Jeff, and I'm kind of like you're thinking about this. But what we saw was well, I could show it in here, right? So the reason I was pitching NVIDIA, and if we do this video thing called the March OPEX effect, and I talk about this in case you want some more details on it. I don't want to take too many everyone's time, but so this is what we call a risk reversal. So basically, if you're into puts, right, if put prices are higher relative to calls, we're going to show up on this side of the screen, and if we're all buying calls, we're going to show up on that side of the screen. Makes sense? And then high IV rank versus low. So options are rich, like super expensive, versus like, I don't know what the opposite is, pennies, right? That's how I look at this grid at a high level. And so the reason I'm showing you this is because if you look at this history, this is where NVIDIA options were on Wednesday, April 8th, last week. Well, where was the market on Wednesday, April 8th? It was not doing that great, right? It was kind of weak. And so the reason I was like, well, I want to buy NVIDIA options is not because I know anything about Blackwell or whatever. It's because the options were so cheap. You can see that IV rank was a 4. That means that the options today or on that day were cheaper than they were 96% of time for the previous year. And so a great trader once told me sometimes you just buy options because they're cheap, maybe because you have no other reason. But in this case, like I'm worried about a right tail move, right? The chance that the market may rally sharply because of a deal, for example, right? And options expirations coming up, and I think everyone sort of had a feeling like obviously, and I know people get annoyed when you hear taco, but if you hear taco and market could rip a lot more than people think because vol's going to get crushed, right? And so you don't want to go and buy a bunch of stock and then you find out the next day that, Trump launched a new armada or whatever and things get worse, right? Because if you're long a bunch of stock and the market goes down, that stinks. But if you own cheap calls and you're wrong, well, you lost money on cheap calls. Like if you're going to lose, that's the best scenario, right? You lose on cheap options, cheap long options. And so the other thing I think about there is NVIDIA is number one in the Qs and S&P in terms of weighting. So I would be hard pressed to believe that the S&P was going to have a massive rally that NVIDIA wouldn't participate in that rally, right? So NVIDIA was basically my proxy for getting long the market. And I did that because the implied vol rank was a 4. And then that risk reversal at 9 is saying that puts were richer than they've been relative to calls, not 90% of the time, right? So let's just sum that another way. People aren't worried about downside in NVIDIA, but they sure as heck don't want calls. They weren't pricing in any kind of a rally. And so I wanted to go, in this case, with 2-month options for the only reason that 2-month options would include the earnings. So those are a little bit richer, but that vol is not going to come in because of earnings, right? So that was the whole thought process there. And fortunately that worked out. And so, why do you say that over spiders in this case? And Jeff, I'd be curious to know if you ever sort of substitute the straddle for, instead of doing Qs, maybe you try a single stock. When you looked at spiders on the same day, it's not like these were the richest things ever, but that IB rank of 25 and this, the risk reversal of 20 just wasn't as good, right? The options are a little bit more expensive, and that risk reversal is, still leaning on the put side, but not as cheap as Nvidia, right? Had this been like Target, the retailer or something, like I don't think I would have been like, I'm going to buy Target instead of spiders. Like I wouldn't have, probably made that same assessment, I guess.
Yeah, that's a good point. Let's see. Devendra was wondering if how we can find out whether somebody bought a large amount of 0DT calls or puts.
Yeah, every minute of the day, this is updating, telling you just that, right? So you can see, if you want to see specifically what the buy side or retail did, you just switch that to customers, and then so at 12:50, the retail or hedge funds, whomever it was on the buy side was short 5,000 of the 6,950 calls, and this is for SPX. We do not have the single every minute data for the spiders or the Qs because that underlying data is not available. You have to have it from every single exchange. So we have end of day data for all exchanges. So we get end of day data in terms of position updates. We do have another tool we call Hero, which help you with spiders and some things like that. But this is the SPX that this trace tool works for. And spiders, has significant volume, but the S&P SPX index options is, it's just massive. If you, in fact, weigh the amount of options expiring on any given expiration, SPX plus SPY is bigger than the rest of the options market combined. So that hopefully puts it into a little bit of a context.
Yeah, notion of value is huge. Let's see. Greg asked, is it bullish if there are a lot more SPX open calls than open puts, since we don't know necessarily who bought the options?
Yeah, we don't. So the thing that you would have to ask yourself is the person who bought this dynamically hedging themselves, I guess you'd want to say. And normally, if you look at how the market makers were positioned here, it's after the close. So I got the data's a little bit kind of these black. So what the black lines is showing you the max position and min position on the day. And so, like in this case, the market makers had on this really big position, right? Here. They had on, and this is the 14th, so this is today. They had on 69.50, and then so they're long these options right here. That's why we're on the right side of this bar, and then they're short these options up here, 6,300, and there's not a lot of puts at all. So what happens in these markets when they rally to all-time highs? Systematically, people come in and start to sell calls, not just 0DT. I mean, there's more 0DT selling now than there's been, but there's also like the JP Morgan Collar Fund and these other funds that will just like try to bring in income, right? And this happens in Apple and Microsoft and all these other kind of like institutional type stocks, right? Even Nvidia, I think, in some ways. And so you rally to sort of all-time highs and you see mostly calls. And it's a mix, right? Long and short calls. And again, I'm only looking at 0DT here. If I expand that, this position kind of blows us out. So I'll try to zoom in a little here. But you can see the map doesn't change all that much. So really all that's kind of going on right now is 0DT. You're not seeing like a big shift in positions. You would see big difference in those two maps, right? If it wasn't 0DT. So the market makers long this position. I know that as factual as, 99.9% accuracy, I would say on that. And then what happens here when you get into we rally to that strike, and then you see that volume start to come down. So they went from like super long that call to closing it. Now they could be closing it because another market maker, it wouldn't be from another market maker, right? It would be another entity type would be selling or buying those calls from that market maker, right? So you would see maybe the customer position would change, or pro customer, which is like, again, like a kind of like it, they operate somewhat like a hedge fund. So there's someone else on the other side of that position, right? That's offsetting that size for the market maker. But the key thing here is that their size started to reduce. So why does that matter to me? Because if I know the correlation between the market rallying to that big strike and the rally in that big strike, there's a really strong correlation there. Well, once that position starts to get closed up, like why do I think the market should rally more? Kind of why do I think the market should do anything, after that, right? And I think that's kind of like the thing I've learned about this is that I want to get, I think we have a great potential of touching this strike. Great. And then we do, and it's like, cool, we did it. But now what, right? Do we think we pin? How do I trade for that? If the positions are still there, do they roll higher? Doesn't really look like they did at this point. Initially, it started to look like they were rolling, and that kind of phased out, right? There's just not a lot of big positions there. Um, this is what we call a high gamma area, so we'd expect the kind of market to do, I think, one of those types of things. I'm saying this with hindsight, so I don't like to get into that too much, but I think what I take away from this is that a lot of times, you get the move and you're like, great, I made a nice trade. And then you close up this position. It's like, well, why do I still want to own that position if the position's closed, right? Like if I based everything off of this strike and that strike started to like disappear, what's my thesis now for wanting to like be long or short or whatever, however I was positioned, right? So I think I've had to learn to sort of be like, well, the position closed, like my reason for being is sort of done here, right? And not only that, oftentimes when you see the position close, it can invoke movement in the market, meaning like market rallies, all the positions get closed, market sells off. So, you can see those times, you can see a lot of times that there's a lot of correlation there. And then the other thing I would just note, even though this wasn't explicitly asked, is, and it gets into the theory of the trading, it's like, okay, if you think that the market is not really going to do anything now, like how do you express that trade, right? Because the straddle here was probably like $8 or something. So it's like, do I want to sell this straddle to maybe make $8? Maybe it was $10 or something like that. Like the risk reward of that's pretty terrible. Even if you're right, and I would believe we'd be right if that position stayed at full size. It's like, can I actually make any money? So even though the market should pin there, is there something to exploit? And what you'll see is sometimes the market will move away, and then you could do like a cheap call fly or something like that to get mean reversion maybe. But again, having understanding what you think the market may do and being right is one thing. How you express that trade and the P&L on that trade is oftentimes, as you guys well know, kind of a different thing. So I hope I answered that question okay. I know I
Yeah,
answered
no,
way more than the actual question.
yeah, no, that was good. I had another question, or if you're able to show how it works in the futures market, so like with ES or NQ.
Yeah, so futures traders use the SPX map. What we do have is something we call Hero, and Hero is a little bit of a different tool, but this actually has the futures data in it. And um, so when you look at the S&P 500, and to put this lightly, because this is like a whole full other presentation here, we have a simpler version of this chart that's a little easier to read when you're getting started. The purple line is what we call Hero, and that is just how many dollars do the market makers have to buy or sell in terms of S&P 500. And so with this, we combine SPX flow, spiders, and ESE mini futures flow. So if you trade options in the ESE minis, we incorporate that into here. So people use this in conjunction with Trace. And all this means is if this line is going up, market makers have stock to buy in our estimation. And is that a lot? 9 billion? Well, look at the last 30 days. The high was 10 billion. So that was a lot today, right? There was a lot of flow into the market for SPX, from SPX, SPY, et cetera. And you can break this down and say, well, is it puts and calls? So it was a lot of call buying, as you can see here. Orange is calls. Some light put selling, but people just got on the call buying bus this morning. And this is not breaking down by entity. This is looking at every single trade in real time and saying, okay, so like looks to us like these options are being bought. And then we go, well, what is this zero DTE? If I add on this filter, you're going to see the zero DTE flow as well, right? So 3 billion of the 10 was zero DTE. That's actually not that high. A lot of times you'll see these two numbers be the same. I love to fade those moves because of the zero DT players. So there was some longer dated call buying active today. That's totally what this reads to me, and in good size too, right? So overall, that strikes me as a bullish sentiment. And I know that contradicts somewhat the fact that I say, well, VIX expiration should make vol expand a little bit, but we could have a short-term consolidation and a long-term rally. And I think that's sort of like how I'm thinking about the market. What about single stocks? So you can add that up. 4.5 billion. That's the biggest number we've seen in the last 30 days. That's a lot. Not zero DTE or this expiration, long term or longer dated flow. So that looks great. If you're a bull, you love that. Like this is about as bullish as you can get when looking at the individual hedging flow of all the stocks in the S&P 500. You sum those up, right? And then, you can look at the NASDAQ in here as well, or just the Mag 7s or whatever. And so those flows, when you look at these are absolutely bullish, right? Now, again, path dependency, right? Do we consolidate a little bit here and that suggests like rally? Like, so would I at this moment think the market has a great chance to be higher in another month? Yes. Do we go down 1 or 2% first? I think so. That's kind of way I would like break out the way I'm looking at the data. Hopefully that makes sense.
Yeah, that's great. And PJ asked, how important is the gamma flip level?
I used to, like in January of 2020 when I first started, like most of what I talked about was the gamma flip level. And for those of you who don't know about that, you can we have a whole free knowledge base, but if you just look at zero gamma or gamma flip, include SpotGamma or don't, you'll find some stuff on that. And basically what that means is like positive gamma is supportive of the market, and then there's a level at which if you go below that level in the SPX, you have negative gamma, which means that market makers are going to make the market drop, right? So market makers go from supporting the market to making the market drop. And that flip level, we call it the gamma flip level or zero gamma. And you could find that in our dashboard in here, like our classic, we call it the vol trigger, right? That's our flip level. And you can actually back test this if you want. There's some like in here, you can go to historical data and like back test, download this and back test. Things have changed because of zero DTE. And so a lot of people will show you a model and they'll say, well, the gamma flip level is at some number, right? But if you look at this chart right here, the entire chart below is blue. In fact, the only part that goes from blue to red, gamma flips from positive to negative, is above. So right now the gamma flip level is above, which tells me that if we break out over 725 right now, this is actually should be a big market chase. Now, in reality, what will happen is if we start to move up, people will start to sell calls. And so I don't think the situation would stay this way. But there's no flip level down below at all. And this is the best gamma data you can get. I know I'm biased obviously here, but banks, et cetera, they don't have, the same level as data. And so, classically you look at one of these, these S curves, right? So this is historically the way that people, and we have this model for free, but this is the way we used to look at gamma before we got this better data. And so you'd say, well, where does gamma flip from positive to negative here? You could see that's right around, let's call it 6,800, right? And I'm looking at that current number, 27 million to -3. So, okay, so you go, that's the gamma flip level. So under that level is where the market should really break. But when you have the data now just says, actually at this moment, kind of doesn't look like it's going to flip at all. If we fast forward in time, it still looks relatively stable. Like this map is still blue at the moment, right? Well, now what's been happening? People have been selling puts, that's positive gamma. People have been buying calls, that's positive gamma. So can you predict how people may start to shift and change their positions now, which may make some of this map more red after expiration and VIX expiration? I think people will start to sort of close up their puts and shift their positions a little here because puts aren't, super high. Like if you're short puts now, why are you still short them? I don't know why you would be really. The vol just doesn't seem that juicy. So anyways, zero DT changes the gamma flip level because 80% or 70% is zero DT volume. So that's a lot of gamma, right? Like we showed the map today. And so if you're not incorporating that into your gamma model, I think you're it's a little inaccurate. Hopefully, again, long-winded explanation.
Michael asked something you I think just touched on, whether there's backtesting tools that inside SpotGamma that you can integrate into to backtest some of this.
Yeah, our number one requested feature is an API. So we have the API, we're testing it, trying to get that squared away, but you can go to the index page and download a historical data of the gamma flip levels and some of those things in the classic strategies. And then in Equity Hub, which is our single stock data, this isn't historical because it's a giant payload, but there is a download button in here for downloading right here. You can export all the levels for single stocks and make your own. Let me chuck it in a Claude and ask it whatever you want to ask it, I guess. So there is some data to download. Full API is something that we're working hard on, and making sure it's all clean. And we have a lot of compliance stuff to check boxes with, which is super fun. So probably going to be early Q3.
Yeah, yeah. Um, Gary's wondering if you can expand on the 7,000 strike open interest, and whether that means it would act like resistance.
Um, you can see here there's a 7,000 and 705. So it's like there's a call spread and a put spread here. As far as positioning goes, I don't think that that has anything terribly meaningful uh, in terms of current open interest. Because this is like a box trade. So there is some positioning there. It's not like massive at the moment, but big round numbers, I'm sure will attract a lot of attention. So I would anticipate that to be pretty strong resistance in the days ahead, irrespective of that giant box spread that's there.
Cool. Yeah, Maureen just had kind of a general question on probability of success for zero DTE or short duration options relative to more medium to longer dated options. And I don't think it's specified whether you're an option seller or an option buyer, but just more of a comment on the risk of short duration versus long.
Yeah. Maureen, that's not a ton of, look, I don't, even if you specified a little bit more, I don't know that I would have what you would be looking for in terms of probability of success of a specific trade, zero DT or otherwise. Um, the way that I like to look at it, or the way that I personally trade, is when we're in like a stable regime, which I usually use this data for. I like to own spiders, like just own the shares, because I think that over time market goes up, and so I'd like to have that as a core equity holding, and then I try to sell zero DT calls against it. I find that the key thing is knowing when not to sell them. Um, because there are these times where the options seem mispriced, or they're just too cheap that you can't justify selling them, for example, right? And when you hit those moments, you go, well, is it cheap enough that I can justify buying those, right? Getting into a strangle. So the probability of success, I honestly don't know. The other thing is, I'm fine with being wrong 9 times, like in a strangle strategy, for example. But the time I'm right, it's like Yahtzee, and I make $100, right? Instead of losing pennies 9 times, but the time I'm right, positively skewed strategy, we call these. So that stuff changes based on, I guess, what the options prices are. And so my general rule of thumb is I like to buy cheap options and I like to sell expensive options, and I want to see like a path for things to be reasonable as well, right? Like, why did we buy Nvidia calls when last week? um I don't, there was a million reasons you could make up for the market to rally. We got some peace deals. It seems like things are calming down there, thankfully. So I didn't sit here and say like, wow, I'm super smart, I knew that the market was going to go up here guaranteed. It was, if the market goes up, I thought it could go up a lot, and those calls were super cheap. So that's why, that's why I went for those, right? Um, would I buy software puts yesterday when they're down, like, or 2 days ago when they're down 7%, right? And you're like, here's IGV, and right here, right? I don't know what software stocks may or may not do, but I do know that vol is about as expensive as it gets. So that means I am definitely not buying puts. Do I want to sell them? Maybe, right? That's a different conversation, but I sure as heck don't want to buy them. So that eliminates a lot of what I want to do. And then what's your window for recovery? If there's not an Iran situation here, I would probably still look at OPEX as a moment to clear out a lot of expensive puts, and then maybe we can rally. I mean, that's kind of like what the point is when you look at the charts. Like, what is your catalyst for change? And a lot of times it's options expiration. I mean, if I was to say, hey, everybody, look at this, and look at the resistance here before, and the Iran war still going on, forget options. Like, you people be like, okay, I could believe the market might top out there. Like, that seems like a resistance zone, I would say. And look how fast this has gone up 9 days in a row. Okay, like, all of us could be like, it makes sense that the market could roll over here a little bit. Now, if we get a full deal, Iran deal Thursday, and risk goes away and oil goes down $20, well, you got to change your, assumptions a little bit on that, maybe. So, just to round out that conversation, is like, price dictates what you can and can't do, or what you should and shouldn't do sometimes, I guess I would say. And again, if you have to hedge a portfolio of software stocks and you don't have a choice of buying options, well, that's a different story. I'm talking about like we're speculating here, right? And so, we're trying to exploit expensive options and cheap options. And sometimes those are short duration, sometimes those are longer duration. And again, like I don't know when the market may rally. I think it can. If we buy the too much option, I have a better chance of that thesis of rally playing out, obviously, right? In this type of scenario where earnings are going to be into play, coming up here. Iran is going to take a couple of days to settle out, that kind of thing. Versus like I see a huge strike up there, it's 50 handles away, and I can buy the spider 1% of the money call for a nickel, right? Well, I'm just going to buy that because I have a great reason to think we could go rally up there, and it's only a nickel. Awesome. If that same spider call was $100, I'm not going to buy that, even though I think it's going to rally 1%. I'm not going to get paid on that. So why would I do that, right?
Yeah,
Hopefully
exactly.
that makes sense.
Yeah, makes a lot of sense. I'll check with Richard real quick. Richard, any questions come through over on the YouTube side?
Yeah, there were a couple questions that came through. One being after they sign up, and let's say they get on the software, do they just kind of poke around and figure things out? Do you guys have training or what's the onboarding process there?
Great question. We have twice weekly Q&A, so that's one thing. We just launched this thing called How to Use SpotGamma course, and so this is every single aspect of our platform. I think it's 72 videos. It's like a course. There's tests if you want to take tests. I skipped the test. Uh, so there's all of that, right? And then we have I do the webinars are recorded, and then we actually have a new AI tool. So like if you ask like what did Brent say in the Q&A last week, it'll talk about, summarize that for you and give. So point is like super structured, twice weekly Q&As, Discord channels. There's a lot of stuff. And I just would say that we try to design everything so it's like don't try to, there's like, don't try to eat the whole sandwich at once. If you trade, with Jeff and the straddle and strangle idea, just for one example, just look for the 99th percentile strike and the market will tend to move to that level. And then, it's like eat the cookie and then find out how the cookie's made. If you really like it later, then you can dive into gamma and positive gamma, negative gamma, and kind of all that sort of stuff. Right. So, I think some people tend to get, in all honesty, a little bit overwhelmed at first, and it's like just keep it simple. Where's the big strike? If it says 99th percentile in that third line down, okay, market has a great chance of tagging that. And what does it cost me to make that bet?
The question came through is let's say someone is a little more new to trading. Is
Mhm.
this a tool that they could benefit from?
I like to think it is a education in a box, but if you don't know the basic of options like puts and calls and stuff, I'll be honest, like you're probably gonna get a little lost. If you want to like dedicate yourself towards like learning the option space and that's something you really want to do, and I think there's a ton of value to that in the modern markets, then we do have a lot of educational resources, and I think you can, you know, uh, come up the learning curve. Let's just say a lot of it is different language too, right? Like anything else, like a lot of Greek language and stuff, which is not necessarily that complicated. It's just in language. But if you don't know what put call is, for just as a rough example, you probably wouldn't still be watching this webinar, I guess. But it is definitely like a little bit more of a learning curve, and so you need to give it a little more time there. And so we do have another tier of membership that's a little bit of a more lower price. You don't get the real time tools, but that may give you some time to like learn some things.
And someone asked, do you offer trade alerts with this?
We don't. We have some alert features in our platform, but they're not, like Brent just did this trade, for example. I don't specialize in offering people exact trades. That's something that, people, like yourselves, Jeff and the Altos group do a lot better for sure in terms of like, this is the time we're putting this trade on, this is the strike, etc. I'll tell you like some rough things of ideas I'm thinking about, in the area of interest stuff, but picking the strike and the expiration and the timing, not something that we do.
The last one I got was, how long would this 75% off coupon apply for? Is it just through now or is it overnight or?
Yeah, we have this deal I think until the 16th. I just saw my partner Matt. He's the one that Sunday he says he did the how to use Spot Gamma course. So I want to make sure I got the number of videos right in that thing. It was 72. Um, so through Sunday, and that's the first month of our premium or highest level, which gets you all these bells and whistles. We are aware that, hopefully you'd want to extend your membership past there. And so, we may follow up with annual offers after that. That's what I've heard whispering in the wind. So first month off, first month discount, and then we could talk after that.
Matt said that you didn't take the quizzes, so we'll have to test you later.
That's fine. If I fail, I'll get a couple weeks off, maybe.
Well, I just see. So I see one more question in the Q&A. I'll relay, but just once again, I encourage everybody to check this out. I've been using this for a little over a month now, I think, and have noticed a huge difference in my trading with it. We don't get any commission or kickback for this, so there's no incentive for me to recommend it other than that I've used it myself, and it's been an incredibly powerful tool. But last question I see in here is, and this is for Brent. Let's see. Does this kind of act as a sniper trade since it's tracking real time towards the trace target?
I don't know exactly what a sniper trade is. I've called it seek and destroy, and what that is this idea that for some reason, wherever these giant strikes are, the market has to move to those strikes. And what's kind of funny about it is if you look at this hero system, this is why we call this seek and destroy, because this is what we call the delta, right? So if you think about delta, that is the buying pressure for market makers. And that big strike was, right here, right? My pen tool is a little crooked, but you get the rough idea. And so what is the seek and destroy? The seek and destroy, if you remember the trace chart, this is where the giant position is right here, right? And so you will see the deltas, which is buying pressure, push the market to that strike. We tag it, and then that pressure fades, right? You can tell it because this purple line actually sells off a little bit and just kind of trends sideways. See that? So you'll see this all the time where it's this massive selling pressure comes in and pushes us down to the strike with the huge volume. It's we tag the strike, okay, flows off, we're done. You want to get into the conspiratorial aspects of why that is or what happens or blah, 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 or it's a dynamic hedging. It's I think it's the theory of relativity, right? You don't always necessarily know exactly what it's doing, but we know that it's true. So it's okay, I see the big strike. The hero signal is going up. It's pushing us to that level. As soon as that level's hit, the flow turns off. And so that's sort of like the sniper in a way to me, I guess, if I'm imagining what you're saying. I call it seek and destroy. If you go on YouTube and go SpotGamma seek and destroy, you'll see a whole video on this too. So that, it's not a new concept around here.
Yeah, Mitch followed up and said change of momentum for zero DTE trades or naked put.
Yeah.
All in the direction of the target. Yeah.
Yeah. And again, I'm sure you guys watch this sort of stuff a lot, but the difference between selling your strangle call here and here, the prices could be totally different, right? Because that energy changes. And so I would encourage you to sort of watch that. Once that momentum just shifts slightly, right? The skew or the vol surface changes, right? Or the zero DT skew changes, and those calls all of a sudden the prices shift a little bit. And I think you could actually add a lot of edge there with the exact timing of those trades. It could be, I think, kind of an interesting thing to think about.
Yeah, for sure. Well, I really want to thank you, especially on behalf of everyone at Altos, all the attendees. I appreciate you being here, Brent. And do you want to provide your contact info? Maybe you already did.
Yeah, but you can. I'm on Twitter at SpotGamma, so you can always DM me there. info@spotgamma.com is our general email, so our customer support and educators are available there. But yeah, you can always just DM me on Twitter. My DMs are open, so that's always a convenient way to get hold of me. And thank you all for the time today. And you gave me some extra time to yap, and so there I go. I yap.
Yeah, it's well worth it. It's well worth it. And yeah, Richard got the link in there for you guys if you want to take advantage of that 75% off. SpotGamma.com/Altos. You get the 75% discount on the SpotGamma tool. So yeah, thanks so much, Brent. Really appreciate it.
Yeah, and Jeff, I'll just close by saying thank you for your time yesterday. I loved hearing a man saying he's going to go and buy some options, or woman. It doesn't matter what your gender is. Buying options, I'm like, wow. That's amazing. And so there's a lot of talk in our Discord this morning about, the strategy and the idea. And like I said, I personally put some of those on today. So I did some futures, and then I did some of the spiders. I like the futures. I'll put the limit out order overnight here. So in case we
Yeah,
get
me
some kind
too.
of big rumble, we'll see what happens. But keep an eye on that VIX expiration tomorrow morning, everybody, and hopefully it'll be exciting.
Yep, yep. All right. Thanks again, Brent. Really appreciate it. Got a lot of thank yous, so take care.